Welcome to this episode of RTO Insights, brought to you by the Association of Progressive Rental Organizations, the National Trade Association for the Rent-to-Own Industry, and sponsored by Rent Direct, a division of Nationwide, the country's largest retail buying group. Today I thought it would be useful if we talked a little bit about liability damage waivers in the rent-own business, give you a little bit of history and legal perspective on that optional other charge that exists in RTO transactions. At the common law, an RTO transaction would have been characterized as a bailment. It's where one party, the bailor, entrusts property to another person, the bailee, with the understanding that the bailee is responsible for its good care and keeping while the bailee's in possession of it, and that the bailee probably has a duty to return that property to the bailor in good condition. Think about taking your clothes to the dry cleaner. You're the bailor and the dry cleaner is the bailee. At the common law, the bailee is liable for anything bad that happens to the property while it's in his possession. And the same basically exists in an RTO transaction where the rental customer is liable for anything bad that happens to the rental property while it's in his possession. That is, in fact, how most rental agreements read, that the customer is liable. By statute, the amount of the liability varies somewhat, either fair market value or the amount of the early purchase option or the remaining payments. It varies state by state somewhat, but the customer is liable everywhere but California. In California, the customer is not liable if the property is lost, stolen, damaged, or destroyed while it's in his possession, unless the rental company can prove that the customer was negligent or did something intentionally to the property. If the customer just gets robbed uniquely in California, the customer is not liable for the loss. But everywhere else, the customer is liable. Very early on, back in the 80s, some insurance companies that were watching the RTO industry grow with great interest approached the industry with what they thought was a new product called lease property insurance that they thought could give customers some protection and help dealers' revenues. Lease property insurance would have shifted the risk of loss really onto the insurance company, and the customer would pay premiums, and the rental company would be reimbursed if the property were lost, stolen, damaged, or destroyed while it's in the customer's possession. The initial rental dealer reaction to the approach of the insurance industry was, oh heck no, we can't do that, possibly because if we start offering lease property insurance, every single customer is going to tell us that their TV got stolen and we'll go out of business. Over time, a few intrepid rental dealers decided to give lease property insurance a try, and what they learned, and what we all know now, is that most people are honest, they want to do the right thing, and they're not going to steal TVs just because they got insurance. So lease property insurance made headway into the industry, but there were issues with lease property insurance. For example, a lot of states require you to be a licensed insurance agent before you can sell insurance. Some states even said you had to have a licensed insurance agent in every store. So there were administrative regulatory issues with the selling of an insurance product in RTO stores. What dealers then figured out was, hey, we can do this ourselves. Thus was born liability damage waiver, an option that exists in rental agreements that shifts the risk of loss for certain enumerated kinds of losses back onto the lessor in exchange for a fee. The common losses that liability damage waivers cover include all acts of God, wind, rain, tornadoes, floods, fires. Some do and some don't include theft. Some rental dealers say we'll cover theft as long as you show us a police report and there's some evidence of forced entry. A few rental thieves, have figured out that they could get a screwdriver and poke around a door and create evidence of forced entry and then steal a TV. There are 9 states that come in and regulate rather rigorously the details of liability damage waivers. They dictate what the liability damage waiver can and cannot cover, and they also regulate the fees. Most of those state statutes say that liability damage waiver must cover loss or damage from all causes unless it's caused intentionally or negligently by the customer himself. However, most states, other than those 9, leave the details of LDW, how it reads and what it covers, to the dealer's discretion, and the marketplace controls the pricing. So, how do you do LDW? Well, you make it optional. You don't want to make it required. If you were going to make it required, then you'd have to add the cost of the LDW to the total cost of the transaction, and that would deter people from adopting it. I think that if it is marketed properly and explained carefully in the store, penetration rates will be high and are high in companies that understand this. As with all insurance-related products, customers are buying peace of mind. They don't want to be liable for big screen TVs in chaotic environments with lots of little kids running around, and you are adding to your bottom line. So LDW is a good thing, and most of you are already using it. That's where it came from. I'm Ed Wynn III, APRO General Counsel, and remember, treat your customers like royalty. They deserve it.